Hello, my name is Yutaka Watanabe, a tax accountant. Welcome to the channel. Tax Accountant Nabe solves your money problems. Today, I'd like to talk about what is a permanent establishment, PE, growing your business and finally expanding overseas beyond national borders. That is truly an exciting and thrilling moment for any company. But in fact, hidden there is a very serious issue that can become the biggest headache for business owners. That is the risk of unexpected taxation overseas. When expanding your business globally, in which country, and based on what criteria will taxes be imposed on the profit your company generates? Today, I'd like to face this question directly and clearly unravel the mystery. Now, let's begin with an extremely important concept that completely determines whether your overseas profits will be taxed. That concept is permanent establishment, commonly abbreviated as PE. It is only two letters, P and E, but they have truly decisive meaning for your business. This becomes the absolute borderline that determines whether your business will be taxed locally or exempt from local taxation. So, let us get right into the substance. We will start by defining what a PE is as the foundation of global business expansion. A permanent establishment, commonly called a PE, is very clearly defined as a fixed place where a company conducts business. The keyword you absolutely need to remember here is fixed place. This does not apply simply because you go on an overseas business trip or have a small transaction with a local client. The biggest point forming the basis for taxation is whether there is a physical and fixed base located there. So, what exactly does that fixed place refer to? In fact, it is very simple. For example, setting up a branch with a company's sign on it, or building a factory to manufacture product. These are places that anyone can see are physically rooted in that country. Such places are clearly regarded as a PE. Now, from here, we move into a slightly serious money-related discussion. This is about the tax difference depending on whether a PE exists or not. In other words, it is the dividing line of fate created by the existence or non-existence of a PE. What is very interesting here is that simply whether there is a PE or not creates a brutally clear contrast between two scenarios. If you have a PE, such as a branch or factory, the profit generated in that country will be fully taxed under the local tax laws of that country. But what happens if you do not have a PE? Surprisingly, as a general rule, business income is not taxed, whether it exists or not. This simple 0 or 100 fact can create a dramatic difference in the point that ultimately remains in your hands. For example, even if a Japanese company sells a large volume of product through an overseas e-commerce site, if it has no warehouse, no branch, and no other presence in that country. Then, as a general rule, the tax authorities of that country cannot tax that business income. This is an extremely important perspective when designing a business model. In reality, the criteria for recognizing a PE may look simple at first glance, but in actual business situations, there are many cases where the judgment is quite difficult. For example, if there is an employee working locally for a long period of time, or if an agent has authority to conclude contract and acts on behalf of the company, there may also be a risk of PE recognition. This is called an agent PE, and even without a physical facility, it can become subject to taxation. It is a rather frightening topic where saying "I didn't know" will not be enough. In other words, the following point becomes decisively important. Let us look at the golden rule in international taxation that must never be forgotten. The golden rule is no taxation without PE. It is a very simple, powerful, and almost refreshingly clear phrase. In other words, even if you are generating massive sales in an overseas market, if there is no fixed price, meaning no PE, in that country, the local tax authority generally cannot tax your business income. This principle is a powerful shield that protects the profit of your important business. However, recently, various countries have begun introducing new systems called digital taxation, which allow taxation even without a PE. So, we are entering an era where we can no longer say that having no PE means absolute safety. It is extremely important to keep up with the latest trends in international taxation at all times. Finally, I'd like to ask you one question. In your current overseas expansion or in the overseas expansion you are planning, where exactly is the fixed place of your business? Please do not let your guard down by thinking, our place is just a liaison office, so it should be fine. To properly avoid unexpected and massive tax risk, please use the powerful concept of PE that you learned today and review your own business structure carefully. Consulting a specialized tax amount or an international tax expert is also a very effective way to protect your business. That will surely become the first step in protecting your profits. That concludes today's explanation. I look forward to seeing you again in the next deep dive. Today, I talked about the topic, what is a permanent establishment PE? For more information about international tax matters, please visit the website of Yutaka Watanabe, Tax Accountant Office. I will continue sharing content related to money, so please subscribe to our channel. Tax Accountant Nabe solves your money problems.